The SPAC mania of 2020 and 2021 was one of the most disgraceful and destructive periods in US stock market history. Special Purpose Acquisition Companies, or SPACs, have been around for a long time, but in the past they weren't very popular. There would only be a dozen or so per year. In 2020, the number of SPACs surged to 248. In 2021, more than 600 companies went public by merging with SPACs. In total, these SPACs raised over $150 billion. The average performance of SPACs has been atrocious. In May of 2021, the ETF issuer AXS created the de-SPAC ETF. This ETF tracks the performance of companies that went public via SPAC. By February of 2023, the value of the ETF had declined 77%. The performance was so bad that AXS shut it down. On average, SPAC companies perform far worse than companies that go public via traditional IPOs. The SPAC process is much faster and entails much less due diligence. Because of this, a disproportionately high number of SPAC companies are fraudulent. Generally, the sponsor of the SPAC is awarded free shares in the company. They don't really care if the business ends up being successful in the long term. They can just dump their shares for a quick buck. The poster child of the SPAC mania was a man named Chamath Palihapitiya, also known as SPAC Jesus. Chamath originally made a name for himself by being an early executive at Facebook, and then running a venture capital firm called Social Capital. He made frequent appearances in the financial media, where he would commentate about the state of the markets in the technology industry. Over the years, he gained a sizable following on social media. Between 2019 and 2022, Chamath launched 6 SPACs that merged with target companies. He leveraged his reputation to convince large numbers of retail investors to buy into his SPACs. Most of these SPACs ended up being disasters. For example, the first company he took public was a space tourism company, Virgin Galactic. The company has been a complete failure. Its stock price has declined by 98%, and it appears to be on the brink of bankruptcy. Most of the people who invested in Virgin Galactic suffered a near total loss, but Chamath did fine. As a sponsor, he received millions of shares for free, which he dumped for a 9-figure profit. Prior to the SPAC mania, Chamath was well respected in the mainstream financial media, but as his SPACs imploded, he became the subject of increasing criticism. By 2023, he was pretty much disgraced. The likes of CNBC and Bloomberg stopped inviting him on for interviews as they did in the past. He is a co-host on a YouTube channel called the All In Podcast, and he continues to remain active on Twitter. Other than that, I assumed he had basically entered retirement. He traded his reputation for hundreds of millions of dollars he made from his SPACs. I had underestimated Chamath's appetite for monetary gain. On September 29, 2025, he made a post on Twitter with the ominous title, "I'm back." He announced that he launched yet another SPAC called American Exceptionalism Acquisition Corp. In this video, we'll explain why Chamath's previous SPACs were so disastrous, and why we expect similar results from his new SPAC. Between 2019 and 2022, Chamath had 6 SPACs which merged with target companies. All of the SPACs start off with a share price of $10. The first was a space tourism company, Virgin Galactic. This company was a complete failure, suffering from numerous delays and technical challenges. Its stock prices declined by 98%. The second company he took public was a real estate company, Opendoor. Opendoor is a so-called iBuyer. They purchase homes from individuals and try to flip them for a profit. Their business model is unviable and they incur massive losses. As of June 2025, the stock price has fallen to as low as 50 cents. Over the past couple months, Opendoor's become a meme stock. The meme rally was catalyzed by a small-time hedge fund manager called Eric Jackson. He posts various internet memes trying to convince retail investors to buy Opendoor stock. His antics have become frankly bizarre. He went outside the hip-hop artist Drake's mansion holding a sign. This was somehow supposed to generate more hype for Opendoor stock. There has been absolutely no improvement in Opendoor's financial performance over the past 2 months. The rise in share price can be attributed entirely to the meme rally. Despite the recent meme rally, Opendoor stock price is still 21% below its initial SPAC price of $10. The third company Chamath took public was a health insurance company called Clover Health. Shortly after Clover went public, the short-selling firm Hindenburg accused him of failing to disclose an active investigation related to potential Medicare fraud. Clover eventually had to pay $22 million to settle shareholder lawsuits. To date, Clover's share price has declined 69%. At least Chamath had one success. In May of 2021, one of his SPACs merged with the fintech company SoFi. SoFi's stock prices increased 161%. In July of 2022, he took a company called ProKidney public. ProKidney is a biotech company trying to develop a kidney-related medication. To date, its share price has declined 76%. Finally, in August of 2022, Chamath took a company called Akili Interactive public. Akili makes video games that can supposedly help children with ADHD. Akili was a failure of a company. In May of 2024, it was acquired for 43 cents per share, 96% less than the initial SPAC price. The average return of all of his SPACs is negative 33%, and this is during a time when the S&P 500 was experiencing a massive bull market. Making bad investments doesn't make you a bad person. It doesn't even necessarily mean that you're a bad investor. Maybe you just got unlucky. But the problem with Chamath isn't just that his companies failed. The problem is the way he promoted his SPACs to retail investors. He did so in a way which I believe to be deceptive. We're going to analyze an interview Chamath gave to CNBC in 2020, shortly after taking Clover Health public. Be warned, this is going to be a long and very technical evaluation, but it's important that we fully unpack Chamath's very manipulative language.
Okay, and then we have to talk about the issue we always talk about, which is fees. And I know we went back and forth on this a couple weeks ago with your last SPAC, and Jay Clayton, the head of the SEC, has spoken out and said that he wants to bring much more transparency to fees, given that you want to democratize the IPO process and allow more retail investors and others to get in. Let's just walk through it. I want you to walk through it in a very granular way, how much money you as the sponsor are getting, what percentage of the company you're getting as a result of this.
So in the case of IPOC, I think we invested $16 million to get it off the ground. Now that the deal has come together, we've invested another $160-odd million in a pipe. The total investment by myself and my partners is about $171 million. The post-money valuation of this business is sort of $5-odd billion, and so we'll own about 5 or 6% of the business.
Let's pause here and analyze what he said. Chamath says he and his partners invested $16 million to get the SPAC off the ground, plus $160-odd million in the pipe, bringing his total investment up to $171 million. The post-money valuation of Clover Health is $5 billion, so he'll own 5 or 6% of the company. But there's a problem with this narrative. 171 million divided by 5 billion is 3.4%, yet he says he'll own 5 to 6% of Clover Health. So how is his percentage ownership so high? He's clearly not telling us the full story.
You'll own 5 or 6% of the business, that's it?
Yeah. Now, from my perspective, I think that that's a wonderful... Go ahead.
Go ahead.
No, I just think, what I'm trying to get across is
there's no warrants. There's no warrants or other preferreds that would get you to a higher percentage of the company?
Again, this is all on a fully loaded basis. So I want to make sure that you're not confusing fees with investment. Fees, I don't make any, right? And just to remember how a SPAC works. A SPAC is not dissimilar to many other investment products. So for example, if you take a private equity fund or a venture fund or a hedge fund, we all operate very similarly. There is a principal. We raise money from investors. We allocate that capital. Typically, funds take a 2% fee every year. We do not. And all organizations typically take 20% of profits if it works. Incrementally, what we do is we reinvest more money from our own so that we are aligned with the company, the employees, and all shareholders. It creates the right alignment. There is no way that I can win unless the stock goes up.
Let's analyze the narrative Chamath is trying to sell here. As a SPAC sponsor, he charges no fees. He just invests in the company. All organizations typically take 20% of profits if it works. Because Chamath invests so much of his own money into the company, he's aligned with shareholders. There's no way Chamath can win unless the stock goes up. This is the fiction that Chamath told the public. Now let's look at the reality. The SPAC that merged with Clover Health was so-called IPOC. IPOC sold 82.8 million shares to outside investors at a price of $10 per share. So the SPAC raised proceeds of $828 million. This was all from outside investors. None of it came from Chamath. As the promoter of the SPAC, Chamath and his associates received 20.7 million shares in exchange for a symbolic consideration of $25,000, basically for free. These shares are colloquially referred to as the promote. This is the promoter's compensation for organizing the SPAC. They can also be referred to as founder shares. When the SPAC was created, Chamath also purchased 10.93 million warrants for $1.50 each. The warrants can convert into common shares at an exercise price of $11.50 per share. In total, Chamath paid $16.4 million for these warrants. If you remember from the interview, Chamath said he paid $16 million to get the SPAC off the ground. This isn't really true because the warrant transaction was not necessary to create the SPAC. It's just an extra transaction they did. When the SPAC merged with Clover Health, the SPAC shares converted into shares of Clover Health on a one-for-one basis. In addition to the SPAC, they also did a so-called private investment in public equity, or PIPE. In a PIPE, institutional investors invest more money into the deal once the merger is announced. In the PIPE, Clover sold 40 million shares for $10 each, raising gross proceeds of $400 million. Of those 40 million shares, 15.2 million were purchased by Chamath and his associates for $152 million. Chamath's total investment was the $16.4 million he paid for the warrants, plus the $152 million he invested in the PIPE. This brings his total investment to $168.4 million. So what did Chamath get in return for his investment? He owned 35.9 million shares of Clover Health. That's the 20.7 million shares he got for free, plus the 15.2 million he purchased in the PIPE. He also had 10.93 million warrants. In July of 2021, those warrants were converted into 2.7 million common shares. This was a cashless exercise, so no monetary consideration was paid. In total, Chamath received 38.6 million shares of Clover Health. He paid $168.4 million, so his cost basis was $4.36 per share. Now that we understand the details of the SPAC transaction, we can identify two blatant lies that Chamath told in a CNBC interview. He said, quote, "There is no way I can win unless the stock goes up," unquote. This is not true. If you're a retail investor and you wanted to invest in Clover Health, you would have to purchase shares for $10. If the stock falls below $10, you lose money. Chamath effectively paid $4.36 per share. Even if Clover's stock price declined 50% to $5, he would still make a profit. As it turns out, Clover has been such a disaster of a company that the share price has fallen below $3, which is below even Chamath's cost basis. But this doesn't change the fact that his statement was false. The second lie he told was a bit more subtle, but equally important.
I want to make sure that you're not confusing fees with investment. Fees, I don't make any, right? And just to remember how a SPAC works, a SPAC is not dissimilar to many other investment products. So for example, if you take a private equity fund or a venture fund or a hedge fund, we all operate very similarly. There is a principal. We raise money from investors. We allocate that capital. Typically, funds take a 2% fee every year. We do not. And all organizations typically take 20% of profits if it work.
Here, Chamath is doing his best to obfuscate the issue of the promote, the 20.7 million shares he received for free as a sponsor of the SPAC. He says he does not make any fees. He then compares his SPAC to a private equity or hedge fund. Many hedge funds have a so-called 2 and 20 fee structure. They charge a 2% management fee on their clients' assets. They also charge a performance fee of 20% of the profits each year. He compares the promote to the 20% performance fee charged by hedge funds. A performance fee is still a fee, so his statement about not charging fees is already not true. But there's an even more fundamental problem. Let's say you invest in a hedge fund. The hedge fund makes a profit of 10% this year. They charge a performance fee of 20% of the profits, so you pay a 2% fee. If the hedge fund has a bad year and loses money, you don't pay any performance fee. The performance fee is based on the profits. If there are no profits, there is no performance fee. Clover Health was a complete disaster. There were no profits. There was a massive loss. Chamath got 20% of the shares of the SPAC for free. This was not 20% of the profits because there were no profits. To his credit, the CNBC host tried to call Chamath out on his BS. Let's have a listen.
But what you just suggested was that you're getting no promote.
No, that's not what I'm suggesting. What I'm suggesting is that you have $16 million initially, plus $160 million on the back. Total. I've just told you what we own.
Even when the host directly calls him out about the free shares he's getting from the promote, he immediately obfuscates by talking about the amount of money he invested. He does this to muddy the waters and confuse the audience. This strategy appears to have worked. This interview was published on CNBC's YouTube channel. The comments section was flooded with Chamath fanboys, saying things such as, "I love how Chamath is so chill while the interview is trying to rail him. Good on you, Chamath. You held up well against this fool. Chamath, way to keep your cool, brother. I would have for sure snapped on this dude. Chamath is the new Buffett. Chamath knows that his retail investors have neither the expertise nor inclination to read through the regulatory filings and see that what he's saying is BS, so he can easily fool them. When Chamath took his SPACs public, he would often go onto the financial media and talk up how great these companies are and how optimistic he is about their prospects. At this point, many retail investors regarded Chamath as a shrewd investor. They were happy to invest alongside Chamath, assuming he had done his research. Take the example of Virgin Galactic. Not only did Chamath take Virgin public via SPAC, he also became the company's chairman. So he seemed to be very committed indeed. This created controversy when Chamath subsequently dumped his shares. In December of 2020, Chamath filed to sell a portion of his Virgin Galactic shares. Knowing that this would likely cause negative sentiment, he released the following tweet, quote, "I sold these shares to help manage my liquidity as I fund several new projects starting in 2021. I remain committed and excited for the future of Virgin Galactic," unquote. Shortly after this, he appeared on the All In podcast, where he again addressed his recent share sale.
To sell some shares of Virgin Galactic. I saw you tweeted about it and you wanted to be transparent. People asked for you to address it up front on the show, so go ahead.
Yeah, I have a lot of projects that I intend to fund in 2021. I'm probably going to put another, I don't know, I think the forecast was almost $2 billion to work. And I needed to manage my liquidity for this year and make sure that, I could continue to make all those investments and fund all of the other things that I need to do. And that's why I did it.
And you're still a significant shareholder, I assume, and you believe in the company.
Yeah, I mean, I remain completely committed to that business. It would have been better if I could have sold something else, but it's not quite possible. And when when you leave the tax year, you just have to make these decisions to lock in some gains against other losses, and would have loved to have not had to do it, but I needed to manage my liquidity, and so I sold. It's a small portion of what I own.
So Chamath sold a small portion of his Virgin shares to manage his liquidity and for tax harvesting purposes, but he remains completely committed to the company. It came as a huge shock when just 3 months later he dumped his entire stake in the company. On the day this was announced, Virgin's stock price declined by 10%. One thing to know about Chamath is that he has very thin skin. By 2023, it was obvious that Virgin Galactic was a failing company and its share price had collapsed. Some Virgin shareholders on Twitter became angry with Chamath for having promoted the stock. One user wrote, "You said buying Virgin Galactic stock is like owning a tech business. Their profit margin is going to be 80%. You sold. Now I'm a bag holder and I lost everything." Chamath replied, "Why did you not sell when I sold? What was your underwriting at that time?" Another user asked Chamath, "How do you live with yourself given the massive losses you inflicted on SPAC holders?" Chamath replies, "I didn't inflict any losses. Stop being a victim. The world will pass you by." The same user responds, "You are a pump and dumper, nothing more." Chamath replies, "I'm in the arena trying stuff. Some will work, some won't. But I'm always learning. You're anonymous and afraid of your own shadow. Enjoy the sidelines." Chamath isn't directly responsible for his followers' investment decisions. Fair enough. But I would ask Chamath, what was your underwriting when in December of 2020 you said you were totally committed to Virgin Galactic, just to dump your entire stake 3 months later? Now let's look at Chamath's new SPAC, which he announced in September of 2025. Let's analyze the lengthy Twitter post he made about it. As you might expect, this post is full of manipulative language and self-aggrandizement. So let's dive in. He says, "When I launched my first series of SPACs, it created several important milestones. We ignited an asset class that has since been used to place more than $150 billion into private companies going public in America. Not only did this grow the total number of public companies, it funded many ambitious projects and goals and reinforced America's superiority in the global capital markets. We helped entrepreneurs and startup employees with a predictable way to go public in a timely and efficient manner that has since become commonplace." Chamath was indeed one of the biggest SPAC promoters during the pandemic-era SPAC mania. But he did not invent the SPAC, nor did he create the extraordinary set of market conditions which allowed speculative investments like SPACs to flourish. Had it not been for Chamath, the SPAC mania would likely have happened anyway. Moreover, the SPAC mania was a disaster. Yeah, companies were able to raise $150 billion, but most of these companies were unviable or even fraudulent. That's why their share price performance has been so bad. The SPAC mania was a massive misallocation of capital that cost investors tens of billions in losses. This is not something anybody should want to take credit for. Chamath continues, all of this said, it hasn't been all roses. I have seen how the perception of SPACs became clouded, particularly related to sponsor compensation, forward guidance, and retail investors' involvement. With American Exceptionalism Acquisition Corp., I wanted to address this directly and make improvements based on what I've learned. He personally takes credit for all the supposedly good aspects of SPACs. He then says that SPACs in general have received a bad reputation due to issues around sponsor compensation and forward guidance. He words this in such a way as to avoid taking personal responsibility, as if it were other SPACs, not his, that committed these offenses. But Chamath was probably the single biggest offender in terms of misleading the public about the fee structure of his SPACs. He also gave absurd future projections about how profitable he expected his SPAC companies to be, which in almost all cases they massively underperformed. This new SPAC does have a different compensation structure compared to his previous SPACs. The founder shares, the free shares he receives as a sponsor, they don't vest immediately. They vest in tranches once the stock price reaches 50, 75, and 100% versus the initial price of $10. But even if the company ultimately is a disaster, the stock price can increase substantially in the short term based on investor hype. For a significant period of time, Virgin Galactic's stock price traded at well over double its initial SPAC price. Even under the new compensation plan, Chamath would have been able to vest his shares and dump them for a massive profit. If the stock price never increases and the shares never vest, Chamath loses nothing. He gets massive upside potential with no downside. Chamath also says he doesn't want retail investors to invest in this SPAC. This deal was built for institutional investors. Specifically, 98.7% went to large institutions, each picked explicitly by me. The remaining 1.3% was allocated to retail investors. This is what you call a red herring. Whenever any SPAC IPOs, the vast majority of the IPO proceeds come from institutional investors. After the IPO, the shares trade freely on the stock exchange. At this point, anybody can buy them. For all SPACs, the vast majority of retail investors buy in on the secondary market, usually after the merger is announced. The fact that most of the IPO proceeds came from institutional investors is largely irrelevant. If he really doesn't want retail investors to buy into a SPAC, why does he post about it on Twitter, where the vast majority of people reading his tweet are likely to be retail investors? While I can't go inside Chamath's head, I believe he's playing a psychological trick. The company his new SPAC will merge with will be so great and so sophisticated that lowly retail investors couldn't hope to understand it. Only the smart, institutional investors like himself can. Just like when you tell a kid he's not allowed to take cookies from the cookie jar, that just makes him want to eat them even more. Of course Chamath wants retail investors to buy shares of his SPAC. He wants the share price to pump so that he can vest his free founder shares. Alright guys, that wraps it up for this video. What do you think about Chamath Palihapitiya? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.